Welcome to this video, which is all about how to trade Forex successfully for complete beginners. Now, in relation to today's tutorial, what I want to do is basically go through a trading experiment. It's probably the most famous trading experiment ever conducted, and what we can learn from it in terms of achieving trading success. Now, the experiment itself was called the Turtle Trading Experiment. It was conducted by two very famous traders, Richard Dennis and Bill Eckhart. They had a friendly disagreement. Basically, Richard Dennis thought that anyone could be taught to trade successfully, whereas Eckhart disagreed. He said it was more an innate gift. So they decided to basically prove who was right. Now, what they did was they put together a simple strategy, had very simple rules, and they then got a group of people together, and they were from different age groups, different levels of intelligence, both men and women. They taught the rules and strategy to them in just 2 weeks. Okay, then they gave them all some money to trade to see how they got on. Now, the group actually made $300 million in 3 years, and on average they were compounding annualized returns of over 100%. So Dennis had actually proved the point that anyone could learn to trade and be successful. Now, in my view, that's a very inspirational story in terms of it just proves that anyone has it within them to achieve Forex trading success. But we know that 90% of traders lose money. So 90% of traders lose money, and the turtles learnt very quickly and were very successful. How did they do it? Why were they so successful in such a short period of time? Well, I think the first thing we need to look at is that anyone coming in the Forex markets is basically programmed with certain biases. They're programmed within us basically naturally, or they're reinforced by society. And if we don't know what they are, and if we don't combat them, we are definitely going to lose at Forex trading. And this is one of the things that they did in the Turtle experiment. They explained the biases that humans have naturally, which cause them to lose in the market. So I just want to go through the biases first of all, then we're going to move on to the strategy. But on the screen coming up, the main biases that will cause you to lose at Forex trading, then we'll come back and discuss them and how to overcome them. Welcome back after that short summary of biases that are naturally within all humans, which we need to overcome if we want to become successful traders. Just want to go through a few of them in a little bit more detail. In terms of humans generally, we really don't like uncertainty, or the majority of people don't. We don't like risk. We're very risk averse. Okay, now in terms of the markets, they're very uncertain. You don't know what is going to happen next. When a trader is trading, a typical losing trader will do the exact opposite of what they need to do to win. For example, if they've got an open profit, and it might be looking like it's going to get bigger, but the trader is so frightened that profit might turn into a loss, the trade is taken in early, trader banks a small profit. On the other side, when the trader has actually got a loss, doesn't want to take the loss, hopes it's going to turn into a profit, so the losses run. We've all heard the old saying, run your profits, cut your losses. That is the way to trading success. Most traders cannot do that because they are so risk averse and not confident in what they're doing. Now, I also mentioned the outcome bias. Now, in terms of as a Forex trader, you've got to get used to losing a lot of your trades and not worrying about it if you've got a strategy you're confident in. Now, most traders who come in the markets, when they get a trade wrong, and let's say there's a string of trades they get wrong, they think there is something wrong with their strategy. There might not be. It's perfectly normal in a probability-based market to take losses and have a string of losses at times. It doesn't matter. If your strategy is soundly based, you don't need to worry about being wrong. You just have to keep those losses small. But if you think about it, in society, we're taught that being wrong is actually bad, aren't we? We learn it at school and so forth. But in the Forex markets, it doesn't matter. You just have to keep those losses small. You're trading longer term. And that's another bias that we have a recency bias, to weight what has happened recently more than what happened in the past. Now, just to explain a few of those biases in a bit more detail, because I think they're the most important ones. But human nature works against us in the market. Now, in terms of how the turtles were taught to trade, they were taught basically that they're going to lose the majority of their trades. It doesn't matter. All they have to do is keep their losses small and run their profits, and basically they'll come out ahead over the longer term. Also, they were told, forget about outcome bias. It doesn't matter. It's a probability-based market. Now, in terms of the turtles, they were losing a huge amount of their trades. I think it was about 70% of their trades ended up losing, but the 30% that made money made a lot of money, easily covered their losses. So Dennis and Eckhart taught them to focus on the long term, and basically the strategy they were taught, they knew the logic of, so they could have confidence in the logic. It wasn't a predictive strategy, it was just a strategy based upon a timeless thing that happens in the market, i.e. markets for most of the time, probably about 70% of the time, don't trend. They just sort of in a sideways channel or consolidation. But there is a trend following phase. We get those nice big trends that happen about 30% of the time. The turtles were told to milk those trends for all they were worth and not bank out early. Now, in terms of the strategy itself, it's very basic. It was based upon breakouts. So basically what they did was they bought a 40-day breakout. The stop was on a 20-day moving average. And they basically adjusted the risk of each trade by the volatility of the market. And they were taught not to over leverage, which is a major mistake that most traders make. They're only risking 1 or 2% per trade. So they could take a lot of trades on the trot that would lose. They'd still be in the game. They could still basically be there to get the profits when they come around. And a lot of traders actually, basically just do not employ good money management. They quickly over leverage, lose their capital. Turtles were taught not to do that. You don't need to use much leverage to make a lot of money. Now, what I want to do now is just give you another quick summary, which is the mindset that was basically taught to the turtles. I've just taken the actual summary from Curtis Faith, who's the most successful turtle, who repeated it in his book The Way of the Turtle, which I'd recommend anyone coming in the markets go and read. It's a fantastic book all about the turtle experiments. I'm just going to let Curtis Faith summarize the turtle mindset. Then we'll come back and discuss how to put your own strategy together and achieve trading success. So here's the summary. We'll be back in a moment to discuss. We'll go back off that short summary of thinking like a turtle. Now, in terms of the strategy, they were taught the logic of it, so they knew it had positive expectation over the long term, and they knew how important it was to be consistent and not deviate from the strategy, i.e. trade it with discipline. And if you cannot trade a strategy with discipline and adhere to the rules, you don't actually have a strategy. They were also taught that if they have a string of losses, not to worry about them, just to keep going, keep being consistent, because good trades would follow, and they must be consistent to catch those good trades which would make them profitable. Now, in terms of the turtles, they were taught prediction is a complete waste of time. You see a lot of people online saying they can predict where Forex prices are going. It's impossible. You need to trade a strategy that is based upon probability. That's the way to win at Forex trading. And in terms of trying to get a strategy with a high number of winners, it's a complete waste of time. Most professional traders do not win the majority of their trades. You see a lot of strategies sold online saying they make money 98% of the time or whatever. They're lying. That is not the reality of Forex trading. You've got to get used to taking a lot of losses, okay? Now, in terms of that summary, I finished up with, if it's a comfortable thing to do, don't do it. If all things are equal. What did Eckhart mean by that? Well, okay, let's say you've got a big breakout on a chart. The price really moves strongly up or down. Chances are that breakout is probably going to continue if it's a strong one. Now, most traders want to do the comfortable thing and wait for the pullback. That is not the right thing to do. If the probability is the breakout is going to continue, you get in at market or where the price is at that point in time. If you've got a losing trade, it's the comfortable thing to do, not to make the decision to cut it and to let it run. Most traders will do that, or most losing traders. Now, another example would be, if your strategy is not working, to change it and look for another strategy. Stop using the one that you've got, you know, and not try and plough through that drawdown period with discipline. So, you know, in trading, you know, the comfortable thing to do is very often the wrong thing to do. Now, in relation to putting together your own trading strategy, what I'd say about the turtle trading rules is, you know, this was done back in the 80s, the experiment, volatility was high. Those rules really worked well. They don't work so well today because volatility has dropped, but there's plenty of probability based strategies which you can use that do work. We outline quite a few of them on our site, but what I would say is, yeah, in terms of getting a strategy, you need one that you're comfortable with, that you have confidence in, and it suits your personality, so you can follow it with discipline. It might be a swing trading strategy, trading moves to overbought and trying to sell, or to oversold and trying to buy. That's a sound strategy. So is a long-term trend following strategy, using breakouts of really big levels. The strategy itself, there's plenty of proven strategies around. You just got to find one that you're comfortable with personally, it matches your risk tolerance, and you really understand the logic and have faith in the logic, so you can follow it long term. In terms of, I think, what the turtle experiment demonstrates is that it is possible for anyone to make money trading the markets, but most traders fail because they cannot overcome their biases. They never research a strategy with an edge that they have rock solid confidence in. A lot of traders try and copy other people or not really have a consistent strategy. So I think, a very inspiring experiment, and I think it's one any trader can learn from. There is a free PDF online outlining all the turtle rules and the turtle trading experiment. I'd recommend anyone who's coming in the markets who wants to be successful go and read that PDF. Now, what I want to do now is finish up with some quotes from Richard Dennis and Bill Eckhart, and the quotes relate to the turtle experiment. They also relate to making money generally from the markets. Really good quotes. Learn them, practice them, and they really help you trade successfully. So I hope you enjoyed today's video. Thank you very much for watching as usual. Take care. Have a good day.